Hello, and thank you for watching this International Financial Reporting for Non-Profit Organisations webcast on reporting entity and control. This webcast is part of a series that covers some of the key issues in financial reporting that affect non-profit organisations. This session begins by looking at reporting, entity and control in the context of NPOs. We will then consider the issues for NPOs. We will then look at how issues are currently addressed in the existing standards, beginning with international guidance. We will then look at some of the current national level guidance. Then we will go on to look at the alternative reporting approaches available, finally looking at how you can respond to the consultation paper. Full transparency over the assets and liabilities of NPOs is critical to financial reporting. Users need to know which activities form part of an NPO's reporting entity and therefore in its financial statements. Users will also want to understand the critical relationships with other entities. Transparency improves comparability between similar types of NPOs that have different operating structures and supports accountability. NPOs may have complex organisation structures to deliver their objectives and often operate across multiple geographical areas. To deliver their objectives across a range of locations, activities may be organised through a series of distinct, separately managed offices. Alternatively, there may be internal allocation of resources, such as members of staff or equipment, rather than a separate office. So NPOs can use different operating models to meet their objectives, and activities may be delivered through separate legal entities or in partnership with another entity. Also, service recipients or supporters of an NPO may form entities to partner with and or support an NPO. Many NPOs operate through a system of branches, which we will discuss in more detail. These types of entity can be used in different combinations, with NPOs appearing to the public to be the same, but underneath there may be significant differences in operational and financial arrangements that impact financial reporting. NPOs frequently have trustees as part of their governance. Sometimes individual trustees may serve more than one NPO. This may result in unrelated NPOs having the same trustees or a significant overlap in trustees. Where this occurs, trustees may be able to exert influence that raises questions about the relationship between such NPOs. Also, if trustees from one NPO have the ability to appoint trustees or board members to another NPO, it is possible that it is considered to be under the control of the NPO that has the appointing trustees. Let's turn now to branches. Branches are typically a self-managed separate office, often in different physical locations. A branch is an internal structure and not legally separate. Branches may or may not be a separate reporting entity, and it may not be easy to make this determination because of the way in which branches operate with other parts of the NPO. So there are important factors about how a branch operates and the support that it receives from the central NPO. Let's look at these. With branches often set up to provide local services, they can be used for fundraising. So branches may have their own bank accounts, with funds raised for specific local projects and funds managed at a local level. NPOs may have arrangements with branches and indeed other reporting entities that allow them to affiliate with an NPO's national brand to benefit from common assets like logos and insurance. Branches can maintain their own financial and governance arrangements, generating their own financial statements. NPOs can face practical issues in producing their financial statements. If a branch operates independently from the rest of the NPO, branches may resist requests for financial reports or not provide other information even if the NPO has legal powers. In practice, it may not be worthwhile to try and enforce financial reporting arrangements if individual branches are immaterial to the parent NPO accounts. But if a branch is not included in the accounts of an NPO, there is a risk that they do not financially report anywhere. For example, a branch might not get included in the accounts of its internationally headquartered organization, but at the same time not considered a reporting entity in the jurisdiction that it is operating, so therefore appears nowhere. This undermines accountability. Where branches are reporting entities, it can improve internal decision making over resources and potential risks. Having described how NPOs can be organized, we now look at some of the key issues for NPOs in identifying reporting entities. NPOs need to follow the requirements of local regulators, which will influence the way in which reporting entities are identified and subsequently treated. Differences in regulation can occur within a single jurisdiction as well as between them. For example, a UK registered charity as a company has to follow the same regulations as companies would, whereas social enterprises follow specific guidance for charities. This may lead to different financial reporting outcomes for similar activities, although arguably in this example, in a majority of cases, the outcome would be similar. NPOs may need to gather substantial amounts of information and carry out large amounts of analysis to make judgments about what is a reporting entity and what is not, and where control lies. Judgment about the degree of control may be particularly challenging because of the types of relationships we previously discussed. In making these judgments, NPOs will need to take account of severe long-term restrictions. These restrictions can limit the ability of an NPO to exercise its rights over another. The identification of severe long-term restrictions requires a highly subjective assessment and may fluctuate wildly over a relatively short period of time. In making judgments, there is also a need for consistency over time. It may be challenging for an NPO to standardize its approach so that users get comparable information. The definition needs to be workable regardless of the way in which an NPO decides to operate. Disclosures can provide clarity about what is included in an NPO's financial statements, which, if any, branches are included, and which entities are controlled. Transparency, including the judgments being made, is needed to foster users' understanding of the financial statements. The International Accounting Standards Board and International Public Sector Accounting Standards Board include guidance on reporting entities in their conceptual frameworks. They have very similar definitions of reporting entities. The ISB conceptual framework states that a reporting entity is an entity that is required or chooses to prepare financial statements. The ISB also has guidance about the definition of control in IFRS 10. IFRS 10 focuses on the substance, in other words, the practical effect of transactions, and not their legal form. In determining control, the key principle in IFRS 10 is that an investor controls an investee if and only if the investor has power over the investee, exposure or rights to variable returns from its involvement with the investee, and the ability to use its power over the investee to affect the amount of the investor returns. The IFR4NPO conceptual framework says that a reporting entity is a government or public sector organization that produces general purpose financial statements. IFR 35 uses the same definition of control as IFRS 10, but has amendments to reflect public sector circumstances, such as the removal of references to investor, the use of the term benefits instead of returns, and clarification that government's power to regulate does not give rise to power for purposes of the standards. Both definitions recognize that a reporting entity can be more than one organization, and that a reporting entity can be parent of a group. They both confirm that reporting entities need not be legal entities. Both IFRS 10 and IPSAS state that to have power over another entity, an entity must have existing rights. These rights must give the current ability to direct the relevant activities. Relevant activities are those activities that significantly affect the nature or amount of the benefits that an entity obtains from its involvement. IFRS for SMEs also provides guidance on control. Control is defined as the power to govern the financial and operating policies of an entity to obtain benefits from its activities. Its definition is more pragmatic. Control is presumed to exist when the parent owns, directly or indirectly through subsidiaries, more than half of the voting power of an entity. In the national level guidance, we have reviewed approaches that are being taken. Some jurisdictions follow IFRS and IPSAS and require NPOs to determine control based on principles that relate to the substance of the relationship between entities. In these jurisdictions, additional NPO-specific guidance is provided. In one jurisdiction, there is a closer relationship to the IFRS for SME standard. In these jurisdictions, there is a principles-based definition of control, with the focus on the voting or operational control of the entity. Guidance is provided about NPO-specific sets of circumstance that would suggest control. Other jurisdictions have provided specific guidance about branches. In one jurisdiction, branches are deemed to be the legal property of another charity and reflect the charity's administrative arrangements. Guidance provided by another jurisdiction includes indicators such as naming, registration, and website. These are designed to assist in identifying if an organisation may be a branch and/or whether a branch is a separate reporting entity. As we have discussed, there is some national level guidance specific for NPOs that could be considered for additional guidance, including branches, which are common within the sector. This NPO-specific guidance would support the alternatives and provide the potential to improve the transparency over the scope of an NPO's activities. Alternative 1 is based on a principles-based approach to determine control over activities. This alternative uses the substance over form principles included in the IFRS standard and IPSAS. This would explain how the principles should be applied and appropriate disclosures. Disclosures would provide information to understand the structure, risks, and impacts of any branches operating within an NPO. Alternative 2 proposes the use of pragmatic models of assessment, such as the power to govern financial and operating policies to define control as required by the IFRS for SMEs standard. This alternative would focus on key characteristics that define NPO relationships. This may benefit smaller NPOs as it is less resource-intensive method of assessment. The alternatives do not address consolidation issues and only goes to what is a reporting entity and where they sit from a control perspective in the reporting structure. Consolidation is not proposed for inclusion in this first phase of the project. This is your opportunity to shape the future by sharing your voice. Amongst a range of issues covered in this consultation paper, we want your views on the reporting entity and control, including how the issue has been described, the alternative options that have been put forward, and the advantages and disadvantages articulated for each option. Please respond to the consultation paper. The consultation period ends on the 24th of September 2021. Shape the future, share your voice, submit your response.